Growth Stage Strategy, episode number 1, Opportunities and Challenges for Growth Stage Companies and Capital Investment. Hey, ladies and gentlemen, this is Michael Hiles with Growth Stage Strategy. I'm here today with Randy Cole, and Randy is a merger and acquisition analyst and financial consultant serving the financial industry and serving industry in the Midwest, and has been involved in a lot of interesting and exciting financial deals and strategies and structures, as have I as well as an entrepreneur. And we decided to put together a little podcast called Growth Stage Strategy to discuss various issues around the growth stage market of business development. So if you're just starting a company and you haven't sold anything yet and you're still looking for your first customer, this will probably be interesting to you because you envision yourself down the road as a successful entrepreneur and business owner. But really the day-to-day issues and things that we discuss in this podcast series is going to be related more towards a company that's already in business, has been in business for some time, and has some nice stable cash flow, and is now looking to take the company to the next level. So without any further ado, I'd like to introduce my cohort in crime here, Randy Cole. Say hey to everybody, Randy, and why don't you give us a little bit of your background and why you got involved in venture capital and how your career evolved, and maybe some of the highlights of things that you've worked on.
Thanks, Mike. Again, this is Randy Cole. I've really kind of wandered into the venture capital space back in the mid-'80s when I was one of the co-founders of the Miami Valley Venture Association in Dayton, which basically was back in the days of venture capital, was so much of a niche finance play that there wasn't a lot of information out there, as opposed to today where it's an actual segment of a fairly known segment of the finance business. And there weren't that many players in the Midwest. There was just a handful of firms operating in the Midwest. So when you set up a venture capital organization, a venture capital club that was really oriented toward trying to find capital for entrepreneurs, and also to attract a handful of venture capitalists to the table so they could learn more about your community and learn more about the entrepreneurs and educate the entrepreneurs as to what this thing called venture capital really was.
Well, it's pretty evil. I mean, most people hate it, right? You know, it's those vultures who are wanting to come and take my company and throw me into the ditch, right?
Well, that really was kind of a common perception to the venture capitalists, and the venture capitalists were always saying, well, no, we're just looking for a fair deal.
More fairer for us than for you.
Well, if you're not a good negotiator and don't know how to properly value your company, then,
these things might happen.
They're not opposed to taking more than probably what they should have, but that's, part of that is your responsibility as an entrepreneur to make sure that you know what's going on. So, I mean, that was basically where it was back in the 80s. And I ended up interacting with a lot of the venture capital community and learning that they had very particular needs as to what they were looking for. We started hearing a lot of things about Midwestern companies saying a lot of these companies are good companies to own and terrible companies to invest in. They just don't have the growth curve that venture capitalists required to achieve a monetization strategy so they could get their money back out. They had a lot of companies in the Midwest that you could start and they would make money and cash flow, but they just didn't have any growth. A lot of the entrepreneurs in the Midwest were happy with that. They could make money and they could pad their bank accounts and they'd pass it along to their kids, but that's not a venture capital play. That just wasn't the kind of growth curve that the venture guys required. So there was an education thing where the venture capitalists come in and said, look, if you want venture capital, you have to do these things. I mean, you have to have a growth curve where you're going from 0 to 100 million in 5 years. You have to have some way of achieving a public offering or making the company attractive so that we can get our money back out at an attractive return. You're not building companies like that. So there was this gap, and the entrepreneur said, this is the kind of businesses we're building. the venture capitalist saying, well, that's fine for you, but not good for us.
Mm-hmm.
So that was the big gap, and I don't know if we've ever completely filled that gap in the Midwest. Now, I still think...
Yeah, when you say venture capital in Midwest, I mean, we're talking about a handful of funds as opposed to in Silicon Valley and New York and Chicago where there's considerably more, right?
Well, and I think from the venture capital side, those guys have really... I mean, it's become more of a global business. I mean, if you're in California, you're not opposed to investing in Ohio if you've got the right idea and the right talent. But you're not. But you're looking at your opportunities in California, saying, well, we've got all these opportunities, and we've got management that's experienced and understand what we want. So to attract that capital, you have to have not only a good idea, but you have to have a killer management team, and you have to have a way for them to believe that the thing's going to have some survivability.
Mm-hmm.
And I don't think we've done well. What the venture capital community has always talked about, in especially in places like the Midwest that don't have a real thick background in venture capital investments, they said the thing that places that have a lot of venture capital in place, well, they've grown management teams where you've got people in-house. That was the number 2 guy at a successful venture capital-backed company that you can pull out, and now he's ready to be the number 1 guy in the next venture capital investment.
Right.
And you've got these guys that understand that rapid growth curve is required for venture capital investments, and guys who have lived through it before, and they understand the dynamics. And you go to the Midwest, and you don't have that many venture capital-backed companies, and you don't have that experienced management. You can just reach in and pluck out a guy and drop him in,
right,
and say, you're going to be able to manage this company to this fast growth curve.
Well, there's been a dynamic, as of late, because we've been through several technology product cycles involving software and the internet now. A lot of the current early stage guys in particular, these are guys that are exactly that. They're founders turned capitalists. They've been through that cycle a couple of times. So, like guys like Mark Suster, sold his company to Salesforce.com and then immediately became a general manager or a general partner at GRP Capital and GRP Partners, and and Mark's.
And the Mark Andreessens of the world.
Yeah, exactly. I mean, Netscape, of course, Mark Andreessen went on to start Andreessen Horowitz, and, they've done quite well. Probably one of the top 3 investors last year in 2012 for getting solid returns from their investments out of the market. So, okay, so then a business owner would talk to a guy like you, Randy, when they're wanting to do exactly what? Nothing like putting you on the spot, right?
No, a lot of times it's just a matter of companies don't have great understanding of what it takes to move to the next level, what it takes to attract professionally managed capital, so they can get into. Think about the conversation I had with some folks that you're affiliated with, talking about their experiences with a bank, and you have to contrast. Well, banks are not people that fund the future. Banks want to bet on your past. Right. Venture capitalists bet on your future. I said these are different animals and have different dynamics as far as how the investments are structured. And I think it's just a matter of people have an understanding of, well, this is how we finance our business. And you go, well, no, venture capitalists finance it based on what your company's going to be worth. Right. Banks don't care what your business is going to be worth as much as they care about, lending to companies that are already worth something and betting on your past cash flow. Right. Venture capitalists will invest in companies that don't have a cash flow.
Well, and that's one of the reasons I call myself an entrepreneur and a storyteller, because it really does come down to
you have to tell the story. That's right.
What picture am I painting in whose mind to convince them that this wild, harebrained scheme that I'm cooking up inside of my cranium is actually going to, create profit and return for folks. So, interesting. Okay, so then you were a co-founder of Miami Valley Venture Association. Now, this was like in, 87? I mean, this was real early.
Yeah, we organized it in '87 and started having meetings in '88. And that kind of progressed through doing some work with the Dayton Chamber of Commerce and other entrepreneurial clients. Asked me to help them structure business plans and help try to get their funding dreams in order so they could at least have some possibility of getting funded.
Right.
And we ended up, I ended up hooking up with Jerry Assinger, who was a local M&A broker, and we founded the Anchor Capital Partners and acquired a company at that time out of bankruptcy called Dayton X-Ray, which became U.S. Inspection Services. And we kind of did that on the acquisition side just because it was an opportunity, and the company had some growth potential. So I kind of I didn't abandon the venture side, but there was a time when, especially in the Midwest, funding acquisitions and funding growth through acquisition was a lot easier than trying to do venture capital plays, just because there just wasn't a lot of venture capital and there just weren't a lot of entrepreneurs that you could sell to venture capitalists as having a good idea plus the management expertise to achieve any growth curve.
Right.
I remember talking to Dave Patterson after he'd started Blue Chip Capital down in Cincinnati, and Dave and I had lunch one day, and we were chatting about early stage versus later stage, and he said, we're not going to do any early stage stuff at Blue Chip. He said, it's too time consuming, you're not investing enough capital, and to really do venture capital well at that early stage, you have to have, one of the guys has to be a really experienced serial entrepreneur that can be hands-on and go in and help these guys put the company together and help grow it. Who has enough credibility with these entrepreneurs will listen to it. Look, I've been in your shoes and I've done this before. He said, we're putting a more professionally managed venture capital firm together that's going to do later stage deals after companies have already been established and already accruing some cash flow, because we think there was such a dearth of venture capital in the Midwest, we'll find plenty of those opportunities. Mm-hmm. And it's just a lot safer play. We may not get the real thick valuations that you get on early stage plays, but it's a much safer play, and we think with Midwestern values and Midwestern investors managing these pension funds, we had better have a real successful first attempt at venture capital, otherwise it won't be a second attempt at venture capital.
Right.
So they put together a strategy that was tied to investing in later stage opportunities, and Blue Chip was very successful. I think they're on their third or fourth fund now. So, but David comes from Boston. He had been with an SBIC, with a bank up there that got acquired by KKR, as a matter of fact. And then he became available, and they recruited him down to Cincinnati, and they with Jack Wyatt, and they put together a Blue Chip venture down there, and they've done real well.
So
not early stage stuff.
Well, and it's back to that issue that you discussed before. Number one, they had to import the talent for professional capital management, and secondly, it's a much safer bet working with more mid-tier growth stage companies, because now, a little bit closer to the banking model, we at least have something that we can point to and say, hey, these guys are cash flowing. They actually they know enough to get to where they're at now, right?
Yeah. And I think from their standpoint, they weren't heavily oriented towards trying to cash in on initial public offerings. They did a couple of those, but it was just as likely that they would get the company grown to a point and sell it to another company, which was not an uncommon exit strategy in the early 90s. But up until the internet phenomena, which caused an exponential growth in venture capital, and it attracted a lot of people into the industry that quite frankly didn't have the discipline to be venture capitalists, and kind of corrupted the market until the internet bubble burst, and then a lot of those folks had to go find something else to do for a living because they didn't have the discipline to be venture capitalists.
Right.
And I think just read an article. They said that $3 trillion in NASDAQ valuation evaporated in 2000.
Yep.
The internet bubble burst.
Oh, it was bloody. I was along for the ride. So.
$3 trillion. That was the other reason I kind of wandered out of the venture capital space. Is that dynamic all started to play out. I got to the point where I just didn't see any valuations in a lot of these that made any sense. And I'm looking at going, there's no there. I mean, what are they investing in?
Right.
That whole notion that you're not going to achieve cash flow and you're not really creating a business. I mean, that intention was to make money just seemed bizarre to me. I'm like, well, if you're not in it to make money, then you're not in business. I mean, you may be creating an organization that does something, but you're not a business if you're not trying to make any money.
Well, I think one of the gaps is that the internet opened up a lot of opportunities to play with different business models, and the traditional business model was completely disrupted, and number one, the internet allows a much faster development cycle on the early stage. I mean, where else in history can we actually start a business, hang out a shingle, and within weeks or months access hundreds or thousands of prospective customers that would potentially pay, and really get those rapid eyeballs at a much lower much simpler, lower barrier to entry in any market, really, because quite simply, it doesn't take a whole lot of effort to. Well, it did back then, but especially now, it takes no effort to spin up a web presence and put a nice logo out in front of millions or billions of internet users, right? So, I think that's issue number one. Issue number two is that. Because of that evolution of the business model, we started to see things like, freemium, where, we're giving away the product on the front end and hoping that, we can cross-sell or upsell subsequent product releases down the road related to, whatever that core initial value proposition is that we're throwing out there to that customer base. And I just think back then we were still so deeply entrenched in traditional business models that there wasn't really a full scope understanding of what that looked like. Now, that being said, now, 10, 12 years later, after the fact, it's nothing to look at a company with rapid growth and many millions of dollars in sales that have, free entry-level price point products and, lots of cool stuff that you get for free, which, of course, has some cost overhead associated with it, but also carries, that either subscription model or some revenue stream attached to it on the back side of it. And I think that's pretty commonplace now. And especially because when you do start talking about those early stage guys that did cash out and now they're the capital investors on the other side of the table looking back saying, hey, we understand this, we get it. So there's this, I don't want to call it an explosion, but it really has been in the past several years, especially, I think, with the downturn in the economy, shaking a lot of managerial talent loose. Guys are saying, hey, I'm just going to start my own company. I'm just going to do my own thing. And so now there's this, plethora of early stage, incubators and super angel funds, and, never before in history was it so easy for a guy with a great idea to go in and get, $30,000, $50,000, $80,000 in early stage angel capital. At least that's the way it's been for the past several years. So, but the focus has shifted.
The whole angel investment model actually came about in the early 90s too, is because there was such a dearth of venture capital that a lot of these guys kind of started getting attracted into investing in these early stage companies. And that became more and more sophisticated and networked because of the internet. And now you've got a lot of these people that have cashed out of these big companies that are playing in that angel space. They bring a little bit higher level of sophistication than, some lawyer that structured a couple of deals and now he thinks he knows what he's doing and he's investing in these companies. Now I think you've got a whole tier of people that are relatively sophisticated angel investors that have been in the tech space and made their money there, that are putting money back in. They're recycling some of those funds back into new ventures.
Yep. Well, and I think this is because there's such a huge early stage explosion. That's really where a lot of the glamour is at. And, hey, I'm a founder. I'm starting a new company. And so, how many companies started last year and got Series A financing, right? I mean, in 2012, there were, I don't know what I saw. The number I saw not too long ago was about 4,000 companies that were identified that could be considered candidates for Series A financing, which is great. It's just still there's cash flowing in, but I'm looking at this thing, and Randy, you and I have talked. We think that there's sort of a gap in the entire capital business development space is that next stage. It's what's old is new again, right? So now we're talking about this explosion of early stage capital, lots of startups, and now that's kind of leading the market evolution towards, hey, once again, now if you're a capital investor, the real serious play is in that growth stage, expansion stage of opportunity. And you really don't see a lot of traction around that. And that's, I guess, really one of the motivating factors from my side of the fence of why I think that it's important to start talking about growth stage and expansion stage, because number one, there are going to be a lot of companies that just can't organically get it together on their own to go from that bootstrap startup phase, early stage, to the stable, expansion stage. And number two, just from a value proposition standpoint in the overall market, you've got these giant funds like the blue chip capitals of the world, the Sequoias, the mega funds, call these guys the 100 million and up capital plays. So they're still looking for a sizable enough of a deal that's going to represent an opportunity for them to cash out and get a nice return. But it takes a lot to manage an early stage. I'm a serial entrepreneur. I've been doing this my whole life. So, to get something going, the amount of inertia to create something out of nothing, and the management curve and the time and the focus and the attention, and quite frankly, I'm tired.
It'll wear you out.
Let's sail into smoother waters here. Let's work with companies that are already cash flowing in that $1 to $5 million a year range, and let's start working on expanding what's there versus trying to create something out of nothing. Because quite frankly, I think there's a ton of value propositions on the table that we have yet. It was like back you and I used to discuss back in the .com era, right? The technology has run so far past the market's ability to really exploit the value proposition and find homes where all of this innovation has happened. And so the commercialization and the monetization of the technology itself kind of outpaced us as just, free market society, right? We got to figure out ways to sell this stuff. And
well, Jeff Bezos at Amazon said he thought when he did Amazon that the infrastructure from the physical side was all in place, and all he was going to have to do was the internet play. He never really thought he was going to have to build warehouses and do all the other stuff that Amazon ended up having to do,
right,
in order to deliver the books, because he assumed that part of it was already done. I mean, that part of it's not new. That people know how to do warehousing.
No, we've been building buildings for a very long time.
And he says, people already know how to do all that stuff.
Right.
But then when he actually launched Amazon, he goes, they can't do it the way I need them to do it.
Right.
They can't do it as quickly and turn things around. Those systems are not set up to meet my needs. I'm going to have to create this from scratch.
Yep. Well, and what's interesting, even with Amazon, what's interesting is not just on the physical side of the fence, but there were no data infrastructures in place at the time for a company like Amazon to manage, millions of product. I mean, there was no such thing as big data in, 1996, right? So Amazon also had to
create computers. Yeah.
So, I mean, Amazon had to also build out that infrastructure, and as a result, they overbuilt it, and then they realized, hey, we've got this massive cloud computing infrastructure that maybe we should partition off and start renting, some of our platform back to customers on the storage and cloud computing side. So it's not just the physical infrastructure piece of it, but they had to invent to a large degree that online,
technical backbone,
that technical backbone is massive, and what it became was a byproduct that they're now selling in the space. You've got S3 services and CloudFront and EC2 and all of these cloud-based computing platforms that Amazon's happy to rent you on an incremental basis. That's, now Microsoft is scrambling to catch up with Amazon on the, the cloud hosting, cloud computing services front with, Azure. I've literally this week have been comparing the feature set between Amazon and Microsoft for the Azure platform, and, God love them. I'm a Microsoft guy, right? So I dearly love the Microsoft stack, but the feature set on the cloud computing services, Amazon's been doing this for a really long time, and they've got a very robust set of features, but that didn't come by accident. I mean, they literally had to build that out, and I don't know, it's just the various opportunities that are available now. It's really interesting, the dynamics that are there going into that growth stage. So as you and I have talked, Randy, this is what kind of is driving that opportunity in the market space for, companies to then align strategically and, more of those growth stage strategy plays. If I'm a CEO of a company that's 1 to 5 million a year in sales, or even 10 million a year in sales, what are the kinds of things I should be looking for from a growth stage perspective versus, that early stage seed capital, get it going, prove the idea in the marketplace? What are some of the high-level considerations I need to be thinking about?
Well, I think you get to that point, and now you've got real products being sold to real customers, and you've got a way to do an assessment of your real growth potential.
Uh-huh.
I think if you're sitting on a company that's 5 to 10 million sales, and you've been around a few years, and you're experiencing cash flow, you've got a couple of parameters that are important from your own perspective as an entrepreneur. You have to look at it and say, I would like to grow my company. Can I do that by myself?
Mm-hmm.
Can I attract capital? Is there a way to grow it? Is the market thick enough for me to expand? What kind of expansion is possible? What competitors are out there that could block it? If I go to the next level and I become on the scope, am I going to attract a lot more competition that doesn't exist right now? I mean, what are the real opportunities? And then I think, and you should be able to assess that because you're in business. I mean, you're already out there and you're selling to somebody. I mean,
mm-hmm.
And then you're looking at it saying, can I take the product and sell it to somebody else, a different customer group that I'm not selling to now, or can I introduce a new product that's similar to what I have that can go after a new customer group and grow that way? I mean, I think they have to do a realistic assessment of what the growth potential of the business actually is.
See, now that's starting to sound awfully close to that evil marketing thing.
Well, right now it's pre-marketing though. I mean, right now you're just saying, is there a market? It's not. Yep. It's not. Can I sell it to them? It's just, is my growth ambition realistic? I mean,
mm-hmm.
You're still doing the market assessment.
Yep.
Which the marketing strategy after you assess that there really is a market.
Which happens to be my bailiwick. That's my core area of expertise is, understanding on the technology side the product development track versus being able to analyze, okay, this value proposition that we're creating here through this innovation and product side of the fence. You'll hear me say it. I say it constantly to people. What specific problem are you solving for what specific customer, right? Because if you answer that question, now you can go out and quantify in a entire global market space. Well, how many of those people are there? How do I reach them? What other transactions are related to this decision to buy this particular value proposition and spend money in this space? What are all the other related transactions that go along with that, right? Because very rarely does anybody buy anything in just a pure isolation. It's related to some chain. You buy a house, right? Now you got to buy furniture. You may hire a moving company. There's just all these related economic activities that go along with some other core decision to buy something. And that's really where I've made my dent in my career, is having both the technical side of the development piece of it as a developer, programmer, data architect, information architect, business analyst. And just I was in the right place at the right time, so I got lucky, being able to leverage my skill set into not just product development, but that market segmentation, that market identification, and that's really what has kind of led me to this point now, where you and I have talked over the past several weeks before we made the decision to go ahead and start recording a podcast and getting serious about this, but. It's modeled. There's a model that goes along with this, a growth stage acceleration model. You quantify a market space, you segment the market, however you want to slice it and dice it and identify it. That segmentation could be based on a product platform, a technology stack. That could be an industry-based segmentation. So there's different ways to slice it and dice it. But in the end, there's this related sequence of strategic decisions around a value proposition or multiple value propositions, where a growth stage company can either explore an organic growth stage development path of their own, or align themselves potentially with other strategic players around a central capital pool, which could be an existing strategic company that's I call it a chassis company, or a roll-up company. But then start to approach higher valuation multiples, because now I'm taking a bigger chunk out of the overall potential market in sales, because now I'm aligning myself with other guys that have, or ladies that have, value propositions that relate to my core business itself. I'm a firm believer that there's an opportunity in that growth stage space to help guide and advise and subsequently invest in companies around accelerating their approach into that growth stage role. And I'm trying to put my money where my mouth is. I've got a live deal. So from your perspective, Randy, what do you see as some of the future of that growth stage? And, as a capital investor, okay, what would I be interested in seeing from the other side of the fence, saying, okay, I get it, we can align these companies. Now, how does that look? Is that a growth stage fund? Is that a consulting company? Is it all of the above? What do we do with this space going forward?
I think it starts with an honest assessment of markets, and then I think it looks at what the true growth potential is. Some companies are not going to achieve venture capital type growth by themselves. So the market's not going to be thick enough for them to ramp up to get there. Or you're talking about it. I mean, right now the cost in certain spaces are not the same as other spaces as far as how much investment's required to ramp up. The cost of ramping up has gone down a lot in the technology space, especially, where it used to be saying, well, if you're a $10 million company and you want to be a $100 million company, you've got a $5 to $10 million capital outlay in order to beef up enough so you can support the additional sales. And I don't think that's true anymore. I don't think you have to have that thick of an investment to ramp up to go from the $10 million to $100 million in certain spaces. Now, if you're a construction company, you do.
Right.
But if you're a technology company, you don't. But I think so you're looking at what is the actual investment required, assuming there's a market there, what is the actual investment required to get you over the hump, to get you to the next level? What kind of talent do you need? Which I think is the real issue as to barriers for growth for a lot of these companies is, can they access the talent that's required? And I think in trying to get up to the next level so that it can accelerate their growth curve.
Right.
And I'm not the guy that can assess that. I mean, I can't go in and say, well, you need this type of talent to take you to the next level. I can tell them, if you assess the market, I can tell you what your company ought to be worth if you can achieve what you what you say you're going to do. But I think the nature of these companies, either they can access that talent pool or they can't. And if they can't, maybe they look at merging with other companies or being acquired so that they can get into a large enough company group that's pre-existing where they can access the talent they need to build the value.
Right.
Or maybe you just cobble a lot of them together to create a big enough company so that now you're significant.
Yep.
But I think but those are decisions that entrepreneurs have trouble making themselves, I think.
So just the bigger picture advisory capacity, number one, is important because then that helps mentor the founder with some guys that maybe...
Yeah, it's not an either-or thing, I think, to start with. I mean, if I was in a capital investment role, I would play that role for a lot of these folks if I had time. Most venture capitalists don't have the time. They just don't have enough time in their day to sit down and educate entrepreneurs as to, well, it's not that you don't have a good idea. It's just that, I think you need to do A, B, and C first, and I'm not in position to help you do those things. I mean,
right.
you do them or you don't do them. And I've got to go to the next investment because I'm busy. So that's where there's this gap where these orphan companies that may have potential, but they can't get to that next level where busy venture capitalists are going to take a hard look at investing in their companies because there's just no one. I mean, they're not ready. They're just not there yet.
Right. So I'm hearing a case then for, back once again to my crazy theories around a growth stage acceleration, incubation, whatever you want to call it. If someone were to sit down with a model-driven approach and say, look, here's your market, here's how we quantify and define the market as a whole, here's your slice of where that market is at, what your value proposition is, here's all the other related chain of potential value proposition and product service opportunity related to that. But at the same time, there's also on the operational process side, right? There's, building out that scalability factor inside of your operations. Because, let's face it, if you're a $5 million a year company, Sally walking down the hall to hand deliver the expense reports to, Jim, the controller, that's not going to work. It might work right now, but that's not going to work in a high scalability model. So, you've got, operational issues that you have to take into consideration. And fortunately, for the first time in history, you're really starting to see business process automation tools, workflow. At the enterprise level, a lot of large organizations are trying to back their way into business process modeling and business process automation. But for an earlier stage company, it's, really kind of a blue ocean opportunity to architect, hey, this is how we want this operation to work going forward. Here's what we think needs to happen in order to really scale this thing from 5 million to 50 million. And here are the information frameworks at an information architecture level that need to exist inside of that organization in order to support that growth. So, from a growth stage perspective, if I'm approaching a capital investor and saying, hey, I need to scale, I need to grow, aside from the obvious, the marketing and sales front end, we have to scale that in order to really exploit that vertical market segment opportunity, which, there's a ticking time bomb on that typically especially in the tech sector because, there's always a life cycle of whatever the current product or the product iteration is, right? So I've got to be able to go out and capture,
It's not as bad as it was. It's not like a week anymore.
Well,
the life cycle's a week.
It's just you have to be prepared if you're going to be in a business and be in a market to go out and grab as much market share and defend it as fast as possible. And that's a business fundamental that has always existed. It's just that product life cycles used to be, decades, and now they are months and weeks, right? So I have to be able to go out and scale on my sales and marketing side to be able to go in and grab and capture. Now, what does that look like? Is that a direct selling model? Does that mean I need to be hiring, sales sales minions, as my partner likes to call them, to, bang away on the phones in a boiler room sales pit. Well, hey, that's one way of structuring. Is that a indirect partnering channel model where I'm partnering with other companies and it's a sell-through situation where now I'm creating a marketing and distribution channels as resellers or referral relationships. But then outside of the sales and marketing scalability, you now have tools and capabilities to rapidly prototype a business process from the operational perspective and really quickly create an information management framework that used to take months and years to put together a robust accounting system and operations management system. Within weeks you can prototype and build that out. It still costs money. It's pure overhead, right? So somebody's got to build this stuff. So if I'm sitting down with a capital investor at the growth stage side saying, what do I need the money for, right? What am I need $2 to $5 million per, just hypothetically, and I'm going to spend, 30% of it on, marketing and sales development. I'm going to spend 30% of that on operational information framework, architecture and framework to build out my operational processes. And, then I'm going to, have a little bit of cash in there for a rainy day fund. And, who knows what targets of opportunity may come about as a result of me traipsing around in the marketplace. Maybe I need a little product dev, to bring my product or services to the next level. But that's really, from my perspective, the focus of the capital investment side now. And because we're dealing with growth stage companies, you have established cash flow, you've got an established market, you've got established product. I believe that it becomes a far less risky proposition for a capital investor to take a look at that kind of a deal and say, yeah, I get it. There's some security with that cash flow model. There's clear-cut objectives of what you're going to spend the money on versus the old school, I need $1 million to create a product before I ever sell it, right?
The other side of that, too, is as you get to a certain size, if you consolidate a handful of these companies or you look at being able to create value in these companies and make them significant companies, the opportunity to hire experienced management at that level is much easier, especially in the Midwest. It's a lot easier to find talented managers that can take it from $100 million to $500 million than it is to try to find guys who can go from 0 to $100 million in that rocket ship ride in the first 2-3 years.
Right.
That can survive and handle all the missteps and all that kind of stuff. I mean, that's a specific type of entrepreneurial manager that likes to go 100 miles an hour with his hair on fire all the time. And we don't produce a lot of those in the Midwest, but we've got a lot of fairly structured management kind of guys that could take it from 100 million to 500 million to manage growth strategies.
Well, I can just tell you from practical experience. From practical experience on the early stage side, the number one issue that I run up against is just the pure risk of the early stage model. So if I'm talking to a hitter candidate that I'm looking to attract or recruit into an earlier stage company, the number one objection is I need to talk to my wife or I need to talk to my spouse about this. This is a risk. We got kids.
Well, what happened in the Silicon Valley? I mean, you talk to venture capitalists out there, and they say, well, the thing is, we hire a guy. This is back a little bit more during the go-go days. He said, well, we hire a guy to come in and drop him into this early-stage company, and the guy knows if the company fails and doesn't work, he can go across the street and get a job tomorrow.
Right.
He said because of his skill sets, some other company will pick him up and give him a job. He said, but if you transport that same guy to the Midwest and drop him in an early-stage company, if that company fails, he's got to move all the way back. He's got to take everything back to where he came from because he can't just walk across the street and get another job.
Right.
He said there's not a thick enough venture capital community, not a thick enough venture capital-backed entrepreneurial community where that guy can go get another job. So if you're recruiting him, he's not just making a decision to take the job. He's making a decision to relocate and to take a much bigger risk that he takes if he's in the Silicon Valley or up in Boston.
Right. Yep.
I mean, that's the reality for that guy. So, I mean, if you're talking about recruiting that guy, you've got two different sales pitches as opposed to just the one that they have out in the Silicon Valley.
Yeah, absolutely. I mean, it's a tough balance being in the Midwest. That being said, it's also flying under the radar. There's a lot of great opportunities that are undiscovered where I think, you run into some crazy issues with, I've been following the traditional capital community's conversation in the past year or so about there being a valuation bubble, right? So
venture capitalists like Midwestern companies, because typically in the Midwest, they get much fairer valuations than they get in the competitive capital markets on the coast.
Absolutely.
They say, we understand there are problems with venture capital investments in the Midwest because of trying to attract the talent. However, you get much better valuations in Midwestern companies as a rule than you do on the coast.
Yep.
Because there's a lot less capital chasing those deals.
When you say much better valuation, to clarify, we're saying, a much closer to reality valuation, right? A fairer valuation.
It's all an assessment of risk. Now, I don't think venture capitalists intentionally invest monies in companies where they're not going to get their money back out of it. But I think they're looking at companies in the Midwest saying a more traditional venture capital valuation from a historical basis can be had in the Midwestern investments as opposed to in California, where a hot deal comes up and you've got 20 venture capitalists chasing after the same deal, and all of a sudden valuations start to get a little flaky. And that can happen anywhere. I mean, the whole acquisition market got out of whack too because of, with similar reasons. There was just too much capital chasing too few deals, and all of a sudden you've got this easy access to capital, and valuations went from a company that should be fairly valued at 4 to 5 times earnings, all of a sudden is selling for 11 times earnings.
Right.
And you're going, but you never get your money back out of it. They go, oh, well, we're going to acquire other companies and create synergies. No, you're not.
Right.
You're just never going to get your money back. I mean, it doesn't work like that.
Yep.
I mean, that's like this hocus pocus math that investment makers like to peddle because they make more money with the higher valuations of the deals, but at some point, capital investors have to take a look going, that doesn't make any sense.
Yep.
And worse, it doesn't make any dollars.
Well, it made sense when there was a crazy IPO market where, retail investors would buy anything, right?
That's the idea. The idea is at times there are markets out there where you can go from sophisticated capital to unsophisticated capital and make money. You can say, I'm a sophisticated investor, and I'm assessing my risk, and I think I can sell IPOs to unsophisticated people that apparently don't know any better.
Mm-hmm.
And I'll reduce my risk, and I'll get my money out of it, and those people will get burned eventually because these companies, I'm selling air. But as long as they're willing to buy air at big multiples, then I'll sell them air.
Yep.
And I think but eventually, that was the definition of the bubble. I mean, it was inflated by air. I mean, there just wasn't any value behind a lot of these companies.
Well, there may have been. It's just nobody knew how to realize it at that point. So it was just purely shooting from the hip, speculative. Hey, if we get 1/10 of 1% of 100 million visitors to our website to buy.
There were, I mean, at the start of the thing, when there were disruptive technologies, there were disruptive models. Because this is the way they traditionally do business, and we're going to allow people to do business simpler, quicker, better, faster on the net. Some of those plays made sense.
Yep.
But the longer it went, the fewer of those opportunities really existed, and you ended up with an awful lot of air. Just a lot of well, yeah, they're doing it over there. Let's do a Me Too type of product, and we'll do it faster and better and cheaper, and then we'll be successful too. That didn't really work that way.
Yep.
That just wasn't the reality of the marketplace. And there were people that were sitting back looking at it, going, I mean, even Red Herring magazine, may they rest in peace, but they had an awful lot of information out there saying, there's an awful lot of air out there.
Mm-hmm.
I mean, even calling Enron on the carpet before anyone else did, saying, these guys are peddling air.
Right.
There's no value behind any of these investments.
Well, I think everybody's learned their lessons on that side of the fence, and it's probably even still fairly concerned. I mean, how much cash is sitting on the bench right now, right? So, I mean, there's a ton of cash. Granted, there's a lot of deals, a lot of early stage deals, but I think that through those evolutions of the markets and, investors just simply, learning the hard way, right? Wow, I'm not going to do that again, right? So I think that there's still good deals to be had.
The amount of capital that's parked is at an all-time high. It almost just has to be. I mean, you look at the amount of corporations that are sitting on tons of cash and ordinarily that would be pulled out into the acquisition market because the economy was down and a lot of companies out there are relatively fairly valued. And ordinarily you'd see a huge uptick in the acquisition market, which hasn't happened for the last 2 or 3 years.
Right.
Some of that's just market uncertainty, but there's no penalty because there's very little inflation. There's no real penalty for them to sit on cash, so they can just leave it parked and just buy money market.
Sure.
And I think but you got individual companies sitting on multi-billion-dollar cash pools.
Yep.
I mean, you go out to your shareholders and you're going, why are you sitting on so much cash? We're like, well, we haven't seen an opportunity we like yet, but we want to keep our powder dry because some may appear, but right now, we're just sitting.
So what I'm hearing is yet another reason, that there's a compelling discussion in this space because, we talk about the plethora of various value propositions and innovation on the early stage side. A lot of companies are out there, got some funding, got some cash flow. They're making some headway, selling into the marketplace, but they may or may not on their own be capable of organically developing a growth stage or a secondary B series type of a strategy on their own. There's great tool sets that are available out there now to rapidly build out information management and operations scalability. And the talent problem is always going to be the talent problem, right? Yeah. But how I say that, however, the tighter that you can model your business processes and the tighter that you can automate business processes around the information flow, the easier it does become to manage because now it's sort of the McDonaldization approach, right? I can quickly just establish the metrics that I want measured, and with wonderful business intelligence dashboarding and things, I can take a reasonably competent manager and train them in my operational systems and say, okay, when this particular chart dips below this level, then here's the sequence of activity that you need to take, and so it kind of really is that McDonaldization of that mid-tier management level. Always going to have the issue on the entrepreneurial, the executive management side. I just think that's the nature of the beast all the way around. But
you also have the entrepreneurial side where some entrepreneurs will get to that. It's like you don't join AA until you admit you have a problem. I mean,
right.
Some entrepreneurs get to that point quicker than others. Some of them get to the point where they overcome the ego part of I can't do this by myself.
Right.
Quicker than others get to that point.
Well, it's a tough thing, especially for guys that have never done it before, right? If they're on their first company or whatever, it truly is it's the fear of somebody coming in and messing up my baby. It's all of those things combined. I know I was there at one point in my career early on, and my startup days of, hey, this is my thing, right? Don't touch my baby.
It's not just my company. It's my being. It's who I am.
Right.
For a lot of these guys, and getting to the point where who I want to become and who I want my company to become. I can't do it myself. I'm not going to get there by myself.
Right.
I'm going to have to partner with somebody. I'm going to have to sell into a group. I'm going to have to do something else other than just what I'm doing right now to achieve the kind of growth I want to have.
Right.
And I think that's, assisting entrepreneurs in getting to that picture and to getting to that point is a valuable service in and of itself, which I don't know that a lot of people provide to these guys. And I don't know if like I said, the venture capitalists could do it, but they don't have time and aren't going to do it.
So if we were to establish, say, a capital group that functioned as a management consulting, marketing consulting, mergers and acquisitions consulting, kind of a hybrid play, and really focused on working with those candidate growth stage companies within a market. What do you think the market looks like from your side of the fence, from your perspective in the capital market side? Because I have my opinions about it. You and I have talked about this offline extensively. What do you see as being sort of the magic mix, given that we are in the Midwest, very conservative? What are the opportunities, the critical risks? Give me your thoughts. That's a big question.
Well, I think I think you've got two things in the Midwest. I mean, if I was in the Midwest, you've got tons of companies that were either acquired or started by people that are approaching the later stages of life. They're going to end up having to achieve retirement by selling their companies. So you've got a lot of traditional capital in the Midwest that is going to be more than happy to acquire those companies that are steady cash flowers that don't have a lot of growth with retiring entrepreneurs. I think you're going to see a large amount of capital transferred to those kind of people. Mm-hmm. Just because, I talked to a buddy of mine with Blue Point Capital up in Cleveland, and they're looking at acquisitions, and they like to invest $10 million at a time. Mm-hmm. And so, but we've looked at smaller deals just because the nature of the market. We're seeing a lot of those companies that have real good value that we don't have to do a lot to. Mm-hmm. Because there's an entrepreneur, they're big enough where the entrepreneur has built a management team and kind of prepared his exit. If he steps out, the company can still run. We wouldn't have to do a whole lot to it. We can buy those kind of companies. And they're looking at those as value propositions, saying we can buy them at reasonable multiples, management team's in place, there's not a lot of growth, but they're making money. So I think you're going to see a lot of the traditional capital in the Midwest flow in that direction because it's just a lot safer. Mm-hmm. There's just a lot. There's just a lot of predictability in what's going to happen in that capital. And the buyout guys, they basically said, well, if we can get 5 years of predictable cash flow and buy it at a fair multiple, we'll make money. Mm-hmm. As long as there's an exit at the end of the day for them, where they can cobble together enough of them, or they can achieve some moderate growth, or they can just sell it to management or whatever. As long as they've got a logical exit at the end of the day, they're happy.
Right.
So, I mean, that's traditional Midwest capital because it's safe and predictable and all that good stuff. And then you've got this other pool of companies that were started with the intention of growing that have kind of hit a wall. That are, because of the economy, because of the access to talent, because of whatever problems have happened, the market was not as thick as they thought, or maybe the market just wasn't as easily accessible as they thought. I built a better mousetrap. How come everybody's not feeding it back to my door? Well, because it doesn't work like that. Mm-hmm. And I think you've got those companies. I don't think there's as many of them, but I think there's a significant amount of them in the Midwest. Some of them have got venture capital funds, and that pool has been exhausted because they're not achieving growth. They're making money, but they're not achieving growth. And the venture capitalists say, we just don't think you're ever going to get big enough for us to realize a significant return. Yep. So, if the bank doesn't want to loan you money, you may have a problem because we can't afford to put any more equity capital into a company like yours. And I think you've got a significant pool of those companies out there that are surviving but not achieving growth. Mm-hmm. I don't think they advertise in the paper. They may be run by people that are young enough or not thinking about retirement yet. So, I mean, that's the pool. I think that's a big opportunity pool. I think the companies of, there's a lot of people out there in the M&A business that'll be more than happy to identify those companies with retiring owners, operators that buyout firms will come in and invest in. But I don't know if anyone's aggressively pursuing that tier of companies that are not ready to have a retiring owner-operator, that are not ready to hang up their spurs. They're still trying to find growth capital. They're still trying to overcome the fact that their bank doesn't return their phone calls anymore.
Now, that's happening a lot these days.
Less now than a year or so ago.
Sure.
The bank's balance sheets are starting to get healthy again, but I think, but it's still, you have to be a pretty outstanding credit to get bank financing. I mean, the banks are still being very stringent on their requirements for who they want to lend to.
Well, and from my personal experience, in working with, I would call this a chassis company or a company around which I would come in, I'm looking for companies that have some sort of legacy recurring revenue base, old customer base that, they're profitable, that it's just almost an annuity, you just keep doing a great job and they're going to keep buying from you, but maybe not a huge forward growth opportunity in the market. Maybe the company didn't particularly invest in a lot of new innovation. They just kind of got healthy on, some large core clients, a small client base, but, they just failed to or chose not to invest in forward market growth strategies. But now, you've got, as you said, some dynamics of maybe a retiring founder or, some other life event, divorce, who knows, you run into all kinds of things with owners of companies wanting to, at least establish some liquidity path out of their investment,
right,
their asset. And using those kinds of companies as sort of the basis to structure an M&A strategy with this model-driven approach to where, we can structure that forward growth game plan. We can bring that capital to the table to help build out those operational pieces, to help buy the other companies, to help, establish and define that marketing and sales in that growth space. But as you said, these guys aren't advertising in the newspaper, Help me use my company as a growth stage chassis, right? If they did that, they would be doing it right on their own.
That's right. Yeah.
So, well, this has been great. This has really been a good conversation, Randy. And you and I have talked about doing this regularly as a regular podcast show, and we've talked about doing a lot of other things around this, including raising a growth stage fund. To do just this, and to develop a consultative approach for both the chassis company, where we've got a cash flowing entity that needs a growth stage strategy, a growth stage model, but also the early stage companies, young founders or even older founders who are early in their startup cycle, but have established themselves, maybe 500,000, $1 million in consistent revenue for a couple years to say, $5 million in revenue. I think that there's a lot of opportunities and a lot of directions that we can take this in. I think there's a lot of folks that would be interested in having these kinds of conversations with us, both, as podcast participants, maybe get some guys on the phone and interview them about their perspectives. Maybe they're doing just exactly what we're talking about already.
I think there's a lot of people out there that could participate and provide some information in this space for people. I think that, again, I don't think that there's a lot of information out there for people that are in the boat that we were talking about.
No, I've done a lot of research. You've got some really key funds that are out there, some players that are doing great jobs, like Scott Maxwell at OpenView Partners. He's kind of, I'm friends with him on a couple of social media platforms. I stalk him quietly on social media, but I'm really impressed with the work Scott's doing at OpenView Partners. I've dissected their entire business strategy and, been a real fan of their group because it is that hybrid group. It's not just here, let me throw some capital at your idea. It's here, we've got a consultative management team like you would not believe. And, we've got portfolio companies that represent, horizontal platform technologies that we can bring in to help you build out your company. And so, Scott, if you ever do listen to this podcast, I'm a banner waving fan, and I've got I'd love to have a bromance with you. We're kindred spirits in a lot of respects. So But it's been good. And, Randy, you got any other ideas on this front?
Well, again, I think we'll just kind of put it out there. I think there's a lot of folks that we could invite to the party to have a conversation. That have been kind of at least on the fringes of what we're talking about. So a lot of the venture guys that would like someone to educate people, and some of them even have portfolio companies that they would like to find a home for to kind of move off the balance sheet because it's not meeting their needs internally.
Yep.
And the companies are still there. A lot of banks I know are getting hit up with people that they think are good opportunities, but they're not in a position to lend to them.
Yep.
I think all these guys have some potential for growth, but that's not our business.
Well, I keep hearing reason after reason that there's bloody chum in the water, and I'm hungry, so...
Thank you, Baron Rothschild, yeah. Violence blood at the tree.
Well, I appreciate the time today, Randy, and we will do this again very, very soon. And ladies and gentlemen, I appreciate you listening and sitting in on the discussion with us today. And if you've got any thoughts or ideas, questions, comments, we're going to have a website available here real soon, growthstagestrategy.com, and we'll be able to engage with you there and with all of the